It is my pleasure to welcome a guest whose work I follow and really, really enjoy. I've been wanting to get him on the show for a while, and here he is. It's none other than Lance Lambert, the co founder of Resi Club, who does some fantastic research into the real estate market, taking deep dives into the composition of everything under the sun. So it's really great to have him. Lance, welcome. How are you?
Yeah, doing great. Really, thank you for having me. And back in October, I left Fortune magazine, where I was the data editor to found Resi Club. And the goal was to build a news and research company that tracks the residential housing space. And according to CoreLogic, the largest asset class in the country, it's not bonds, it's not stocks, it's residential real estate.
Yeah.
And I just kind of felt like, the information out there, especially from the main, the bigger publications and mainstream media, just isn't great. And so I just wanted to build a publication that was just hyper focused onto residential real estate, whether you're a single family landlord, agent, buyer, seller, homeowner, loan officer, builder, the whole spectrum across the housing sectors who I write for and research for.
It's really great because a lot of people in your space or kind of the related space really focus on serving the developers, the home builders, that kind of stuff. And of course, there's tons of stuff in the commercial real estate world. But I think your content is pretty well targeted at like single family landlords. And that's our audience too. So it's really perfect. Maybe the big broad question to start with, Lance, and by the way, we've got a whole bunch of things we want to cover with you, not the least of which is the big NAR commission lawsuit settlement that happened recently. And, is that really a nothing burger or is it the big change the media is portraying it to be? We'll talk about that. But, just your view of the real estate market overall, supply, demand dynamics. Feel free to share any charts and graphs you want to put up on the screen as well.
Yeah, let me just go ahead and start sharing then. I think if big picture zoomed out, the most important thing to know about the United States housing market is that it's fairly tight resale supply. And so that should be your starting point with any discussion about the housing market, because from there you can start to understand why different sectors and different subsectors within the market are reacting a certain way. And so this is my favorite metric. If you just gave me one number for a county or metro or even like zip code, if I could get any number, I want to take inventory where it is now for active listings versus the same month in 2019. And what you will see is that on a national level, we're still down about 35%, 30% from pre-pandemic 2019 levels.
Before we go into that, so we're down 30 to 35% from pre pandemic levels in 2019. Okay, great. But what I think people have to realize with that statement, Lance, is 2019 was by no means a bad market. It was by no means a buyer's market. I
Yeah.
mean, we were doing solid business in 2019. Lots of people wanted to invest and buy nationwide. So there's all these comparisons from kind of the crash bro group of, hey, it's another 2008, right? It's another great recession. It's another financial crisis, or they think that's coming, I guess I should say. 2019 was still a pretty solid market, right? Would you agree?
Yeah, so 2019 was several years of falling active listings. They've been
Yeah.
drifting down for years. And so 2019 was fairly low. Now, I will say that when you compare actives now to versus 2019, and if a market is at or much more above 2019 levels, they have seen more softness and more weakness, and maybe even some declines like a market like Austin. And one reason that it's weaker once you get to that level is because, yeah, 2019 was very much a seller's market and very low actives, but affordability now is so much more strained than 2019 that
Right.
is one thing that kind of equals it out a bit. But yeah,
Sure.
you're absolutely right.
Yeah.
But active listings throughout the US, the Northeast, very tight, the Midwest, very tight, Southern California, very tight, New Mexico, up into like Wyoming, very tight. Through the South, you get some patches here or there. And really, the reason for that is that the South had a good amount of, and in Central in Texas as well, had a good amount of new construction. So as the rates shot up, and some of those builders made affordability adjustments in some areas, some of the resale market, if sellers didn't come back a bit or got, kind of went too high, it gave actives a breathing room to rise. Not
Mhm.
crashing. I would actually classify it more as normalizing, but still a tight resale market. And so if you look at this one, okay,
There it
see
is.
the brown very tight here,
Yep.
very tight out here, a little weaker through here,
Okay.
and Florida a little patchy here.
Overall, nationwide inventory is very tight, very constricted. There are a few spots in Texas mainly and a couple of southeastern spots that show a little bit more of a relief in terms of a normal inventory market because builders were building there in a lot of those areas. There's just more land to build onto. If you have any comments on that, feel free, Lance.
Yeah, that's it. And then if you take that map and then look here, where you see inventory has moved up the most, some of them are kind of flat, mild price declines. And then a lot of those areas where actives are very, very tight, like Connecticut, for example, is down in most of the counties throughout Connecticut, down 80% from pre-pandemic levels.
Yeah, and
So
that's probably a lot of that could be attributed to people leaving New York City, right?
it's the donut effect, exactly. Where during the pandemic, a lot of like those secondary markets like Austin and
Yep.
Boise kind of boomed and throughout parts of like Colorado and Utah. But as the offices started to reopen,
Mhm.
what we started to see more was the pandemic migration and work from home effect was still there, like that work from home arbitrage. But what was going on, it was deeper into the exurbs like
Mhm.
places to where you couldn't reasonably commute into the office every day, but
Right.
maybe you had to go into the office every couple weeks or
Yep.
monthly, it was doable. And
Right.
so really far out in New Jersey, I mean, Mercer County, New Jersey, it's up 11% year over year for prices, despite mortgage rates going up to 7%.
Yep.
And Hartford County, Connecticut is up 12.8%, despite, mortgage rates going from 3 to 7. So
Mhm.
you really see that donut effect there. Yeah.
Talk to us a
And
little bit about, Florida, Alabama, Tennessee, Georgia, Arkansas. These are markets a lot of our investors like. They're obviously very investor active markets. And I know it's spotty. Everything is, all real estate is local, folks. It's very localized world, but your map is pretty localized too. So,
yeah, so what's happened in Louisiana in particular is there's been some home insurance shocks on
Mhm.
top of the fact that we went through an overheating on price growth during the first 2 years of the pandemic. And then we had a rate shock going from 3 to 7. And then when you add in those home insurance shocks, that just puts a few markets where the affordability gets too strained. And
Mhm.
everywhere in the country has essentially, during the mortgage rate shock, gone down for supply in terms of new listings coming into the market, the lock-in effect. And then everywhere is essentially came down on demand as well. So the market has been constrained to both sides. But what's happened for pricing is in a lot of markets, if you went down for both, kind of like the Connecticut's of the world, this is just economics 101. If the supply and demand curve moves together, pricing can continue. And some markets we've seen demand pull back more than the supply pull back. And that's been the places that have softened more. And if you have that third affordability shock, where you not just the price shock, not just the rate shock, but also the home insurance shock, that's been some of the places where you've seen more of that demand pullback. And then some of the investors just having a harder time finding cash flow. And so that's created some of the weakness in some of those parts like Louisiana.
Lance, do you look at anything internationally? I'm just curious.
I'm very focused on the US housing market. So
Got it.
when I do things like international, it's maybe like comparing like our mortgage market
And I
versus the rest.
remember I remember reading this chart. Yes,
We're,
that
we're,
was interesting.
we're
Yeah,
the spoiled kids. Yeah.
yeah,
We have, these fixed mortgages, 15-year, 30-year.
yeah.
And yeah, that's an anomaly in the rest of the world. And so for them, they're feeling that squeeze of the rate shock more on the homeowner side. It was
Absolutely, absolutely. Here's the reason I ask you about the international thing is that when you look around the world, amazingly, as unaffordable as everybody seems to feel the US market is, it's actually not that expensive compared to many markets around the world. And the US is actually sitting pretty well. It's like a semi reasonable affordability here versus, you look at the UK and it's impossible. Just give up now, right?
so
You know,
a few things there. And one core thing is that a lot of those countries don't have the American South and the Sun Belt, where
Right.
they're very friendly to home building and there's a lot
Yep.
of home building going on. And so the supply in the US, even though we're probably underbuilt
Hmm.
and estimates are somewhere between like a million and 5 million, we're still better off than a lot of those other countries
Right.
that have made it so hard to build.
Yeah. Yeah. Yeah, absolutely. But my point in asking you that was, there seems to be this kind of mentality out there that just because things were more affordable in the past, and certainly during the pandemic era, they were extremely affordable. But even before that, in the last few decades, right, things were, more affordable, that they have to somehow return to that, like they have to regress to the mean. And I think that's just a faulty idea on its face. Just because something was better in the past does not mean it has to return there.
I think one thing to keep in mind is, and I think everyone should go look and just kind of like Google housing affordability. When you take into account mortgage rates, home prices, and incomes, the 2010 to 2021, that was the best period ever,
Mhm.
essentially.
Yeah.
That was the lowest housing affordability or best housing affordability you can find in 50 plus years. And there's no guarantee we're going to go back to that.
Right.
Now, what might be more likely is that, we've gotten strained once we hit like 8% mortgage rates or 7. So maybe over time, if mortgage rates come in a bit and if home building continues to maintain and home price growth, maybe income growth could exceed home price growth for a bit, we
Mhm.
could ease a bit on the affordability, but it's not going to take us back to pre-pandemic affordability.
Yeah. So I think those nostalgic times, we just have to understand it's very unlikely that that is coming back. So that train has left the station, the ship has left the dock, whatever you want to say about it, from whatever cliche, just people have to just deal with that and make decisions now. The best time to plant a tree was 20 years ago. The second best time is today, right? Just move on, right?
Yeah.
Yeah. A lot of people are
And
stuck in
then
that. And
if you go back 2 cycles, really, or almost 3, and you go back to the early 80s when affordability was last strained to the levels that we saw at the end of last year, once we got to 8% mortgage rates,
Mhm.
from that point on, heading forward, yes, affordability improved, but also home prices kept going up. So if you
Mhm.
waited until the mid 90s when housing affordability really was improved relative to the 80s, because it was a slow grind down, home price appreciation had already ran really far up beyond those 1981, 1982 levels.
Right. Yeah. Yeah. And by the way, you mentioned cycles go back, 2, 3 cycles. How long is a cycle in your eyes?
I think cycles can be measured different ways, but I think the way that I'm talking about with the cycle is really just, affordability getting strained,
Hmm.
running up.
Okay.
So the last run up in affordability was like the 2005, 2006, and then the rollover, which is really that period is a historical anomaly, because that's just not how we've usually rolled off of an affordability being pressurized like that.
What else would you like to cover in this thinking about the market, where we are, where it's going?
One thing that's important is, and I don't know if I have a chart too handy here, but I guess I could look at this one to show a little bit of it. But one thing that has occurred is that the resale market has stayed tight and that home builders, their profit margins during the pandemic went to the all-time highs. They'd never been as high as they were during the pandemic, and they had all the pricing power. Well, once mortgage rates shot up in 2022, what occurred is builders used some of those margins to do affordability adjustments, really mortgage rate buy downs.
Sure.
Some things are still playing out kind of like smaller homes going to meet the market. And they did all of that. And of the 10 home builders that I track, the 10 biggest publicly traded, 9 still have margins above pre-pandemic levels. So they've
Hmm.
went at the market and they still have above pre-pandemic level margins. And so what you haven't seen happen is a big hit to single family home building in terms of like the number of homes. Yeah, you've seen starts and stuff roll over, but in terms of the completions and stuff, we haven't seen a big hit. And a lot of that's still rolling through the pipeline. So
Multifamily. Yeah.
yeah. And so while the rate shock has caused layoffs for, mortgage folks, and some real estate agents have left, and title and some of that stuff on the pure transaction side, the big kahuna in terms of the transmission mechanism from housing to the rest of the economy, residential construction, has not rolled over.
Mhm.
Builders made the affordability adjustments, came down a bit on margins, and continue to sell. And so residential construction employment is actually essentially at cycle high still.
Mhm.
So I think that matters if you're, kind of a nerd and trying to understand how does housing impact the rest of the economy? And then also where does, the rest of the economy head forward? I would think if we're going to go into a harder landing or a recession, I would think just based on history that residential construction would have to roll over before that would occur. Maybe I'm
Mhm.
wrong. Maybe it's, an outlier, but that's historically how it's gone. And right now, we're just not seeing that big hit to residential construction.
Yeah, and one comment on that is that the builders have a real shortage of workers. The average construction worker nowadays is basically around 50 years old. It's crazy how that has changed in the past few decades. I mean,
That's right. And so there's
these guys were 20 years old 3 decades ago. Just think
one,
about that. They're the same
one
guys.
One theory is that there's some hoarding going on because the builders know even if things were to change, right, or they were to slow, that long term, and especially in the next couple of years, things are good for them, they think, because there's a need for single family homes in the United States, and they believe we're underbuilt. So even if we started to see a bigger hit to them, they might not make the job cuts like they would have in the past. And
Right.
here's the largest home builder in the country. This
Yep.
is the margins for D.R. Horton. You can see during the pandemic housing boom, they just went to really high levels, right? They had
Okay.
all
So,
pricing
so,
power.
so DR Horton's margin during the pandemic, 31.8%, and now it's about 24.4%. That's a lot of pricing power. That's incredible pricing power. So before the Great Recession, going into it, their profit margin's 28%, but during the Great Recession, it's negative 10, right?
Yeah. So yeah, they've made some affordability adjustments with like the mortgage rate buydowns and stuff came a little bit off the frothy peaks, but
Yep.
still in a fairly good spot.
One thing is interesting, and I think this is going to skew the statistics. I'd love to get your opinion on this, Lance. And that is that the builders have adjusted for the affordability problem, as you know, and they're now building smaller houses with cheaper finishes to try and meet the market and address the affordability challenges that people have. I think that's going to skew the statistics and give fodder for this argument that, prices are flat or prices aren't going up that much or prices are coming down. But the problem is it's not an apples to apples comparison, right? Because the house got smaller. Do you want to comment
And
on
we're
that?
going to continue to see that heading forward is essentially we had 40 years of homes just getting bigger and bigger and
Right.
bigger. And
Yep.
the housing bust that occurred actually hit the bottom of the market harder than the top. So builders can build more of the top, the bigger homes, right? And so we finally peaked out in like 2014, 2015-ish, 16, and we've slowly inched down. And you don't see it here quite yet because my data is lagging, but you will see a bigger drop off here because now you have two things occurring. You have the fact that there's the demographics and households are getting smaller in the
Mm-hmm.
United States, right?
Yep.
People are having kids later into life, more singles are buying, all of that. So that's the demographic tailwind that's going to reduce home size. And then what you said, which is the affordability side, is that the market now, because affordability strain, builders are like, you know what? I'll just get smaller on the home. And that's how they lower the price instead of actual outright cuts. They just build a smaller home to get that
So,
buyer.
so, so just to tell, if you're listening on audio only, 11 years ago, okay, or 10 years ago on the chart, because the data lags, like you said. So, in a 10-year period, the typical new house got 300 square feet smaller, okay? And part of that was builders trying to address the affordability problems and sell smaller houses. They're obviously less expensive to construct, but also the demographic component of fewer people getting married or at least getting married later, fewer people having children. Yeah, I tell you, that demographic problem is going to hit us by about 2050, and we're going to wake up and think we got to have some kids. But
Yeah,
that's a different
yeah.
discussion.
But as an investor, you can kind of see it heading forward.
Yeah.
Exactly. Yeah.
Lance, let's talk a little bit about all of these people that have these extremely cheap mortgages, and just rough numbers here, approximately 25% of the country has a mortgage at or below 3%. 65% of the country has a mortgage at or below 4%. Money is a commodity too, and they can't get that cheap money anymore. It is gone. There's no bargaining on money, really, right? Yeah, I mean, you can rate shop a little bit, but it's not going to be any dramatic difference. So they don't want to give up these great, really cheap mortgages on which they have, 28 or 27 years left, right? So
Yeah.
how do we ever solve that lock-in effect problem?
Yeah. So it's
If it's a problem that we don't have enough inventory, right? That's the problem. When I say it's a
yeah.
problem, yes, but if you own a lot of real estate, it's great because it's going to keep supply low, and that's going to put upward pressure on
I
prices.
think what we can assume is that there's not going to be a crazy amount of turnover in the market, right? Not a lot of churn, like this home selling and this person then selling it and going buying something else. And we were already seeing less churn, what I call churn, which is somebody selling to buy, but really, usually more broadly, they just call turnover, right? So
Mhm.
what had happened over the past 10 years is that as baby boomers were becoming a larger and larger share of the housing market, and they were choosing to age into place, we were seeing less turnover in the housing market. So turnover used to be 7 years, and now it's like 12 years.
Yep.
And another reason that it got bigger is that there was a good number who bought before the bust who were then underwater and they just couldn't sell, right? So we
Mhm.
had those things come together that was pushing turnover up. We also had a few smaller things that don't get talked about much, like the fact that there's more reverse mortgages in the US, which
Mhm.
has also helped to lock in people.
Yep.
But now we have a whole new lock in, which is we had 40 years of falling mortgage rates. And then in, early 2021, we hit the lowest mortgage rate ever for 100 years, which is down into like the mid twos. And then we quickly, as inflation took off and mortgage rates moved up, it's created something of a lock-in effect. And this is probably the worst one we've ever seen. If you want to find one even comparable, you would have to go back to the early 80s. And so FHFA, the researchers over there published a 52-page paper last week, and they found pretty much what we already knew, which is there's a lock-in effect in the market. And they said this mortgage rate lock-in has led to a 57% reduction in home sales with fixed rate mortgages
Wow.
in Q4 2023.
That
And
is staggering. I just don't want people to pass that comment by, Lance, because it is staggering. The mortgage rate lock in effect has led to a 57% reduction in home sales. With
yeah,
now, these are home sales with these fixed rate mortgages. That's the ones they're talking about
yeah,
in the last quarter of last year. I mean, and that prevented 1.33 million sales in about an 18-month period there.
yeah.
So
So
that's
while home
huge.
sales in the US are not down 57, the group of what I call churn, which when I say churn, I mean somebody who sells a home and goes and buys something else. Those people, those are the ones, the 57% reduction, because you still have the deaths, you still have the divorces, but
Yep.
of that churn side. And you could see, 1.3 million knocked off in 4, 5, 6, 7 quarters.
Wow.
And the crazy thing is that the economist over there, which they created this calculation, which is saying that this is the effect, the difference between the prevailing mortgage rate, which today is like 7, and the effective mortgage rate, which today is around 3.94,
Mhm.
what impact that's having on home sales. And so they've created this calculation. And so when mortgage rates fall, sometimes it becomes positive effect. And when they, rise a bit, it temporarily goes the opposite direction. So like during COVID, when mortgage rates went down to like 2, 3%, that was a positive, right, on the lock-in effect. And then as they went from 3, 4, 5, 6, 7, 8%, it's created a historic lock-in effect.
Mhm.
And they do think that we've essentially bottomed in terms of like this is the worst, right? In terms of the suppressed new listings. But if mortgage rate did go up another percent, they do think it could get a little worse. But even if mortgage rates fall a percentage point from today, it's still going to be here. And even if they fall 2 percentage points, so down to 5%, there would still be some type of lock-in effect for the next decade. So there's going to be a lot fewer existing home sales than there would have been had the pandemic and all the policies and everything that happened during the pandemic not occurred.
It's just staggering. It's a very different kind of world nowadays, folks, because of these long-term fixed rate, 30-year mortgages. So, Lance, one of the counterintuitive things that I've been saying is that, and this is what people have not understood very well, is that most people think, and they're right in most scenarios in the past, right? If you look at history and you say, hey, rates have gone way up, affordability has gone way down, that's going to crash the market. But what they didn't consider is all of the existing mortgages that literally became more valuable as rates went up. Because when the delta gets bigger, that existing mortgage at the low rate becomes even more valuable to the person who has it.
Yeah.
And this is something people have not understood very well. I've been beating the drum for a couple of years. And the people who got it wrong are the ones that said, hey, here's the experience a new home buyer has coming into the elevated interest rate market. We have elevated prices, elevated rates. They can't afford it. It's tragic for them. But what they didn't really think about is how it was for all of the existing people, which is 130 million plus houses. Well, a lot of them didn't have mortgages at all, so that's not accurate. But 60% of them do have mortgages. And assuming a large percentage of those have the low rate mortgages, that's the component that mattered because that's where most of the inventory would have come from if we
Yeah.
didn't have the lock-in effect.
And in terms of like that piece of it, Morgan Stanley, they've named it this phenomenon, which is last cycle, the homeowners were essentially the weak hands, right? There were so many people in that pool that had distress that, they shouldn't have been in the pool, right? They were given mortgages they shouldn't have had.
Right.
Also, some of their payments rose over time. And so they were the weaker hands. This cycle, Morgan Stanley says that the homeowners are the stronger hands.
Yeah.
It's different lending. They got these fixed rates, 2, 3%. Last cycle, there was a lot of people who would just walk away, hand the keys back in. It was cheaper for them to go rent than pay on that mortgage that was
Right.
underwater.
And now it's cheaper to keep your mortgage and it's more expensive to go rent, which
Yeah.
is, yeah, right.
If I left here and had to go rent something, I would get something much smaller and pay more. It's a different cycle. And, you can't just take what happened the last cycle and say it's going to happen this cycle. Because at the end of the day, to move house prices down, you need a lot of supply. And you need a particular type of supply, which is they are selling and they are not buying something else. So even if the lock-in effect were to ease up, let's say mortgage rates come down, the people who would be unlocked are people who have 2, 3, 4% mortgage rates who'd be like, you know what, they've come down to 5. That's low enough. I've had another kid. I'm moving on with my life. I'm selling. I'm buying something else, right?
Yeah, right.
When they sell, they're going to go buy. They're a seller and a buyer.
I'm so glad you mentioned that because then that does not increase inventory, right?
Yes.
It's a trade. And these people, the things you didn't mention is number one, those people have a lot of equity, number one. And number two, they were underwritten under very strict mortgage underwriting guidelines, and they have fantastic credit. You look at the credit scores of the existing mortgage pool out there, and these people it's the complete opposite of distress.
And what's going to happen to a good number of those homes is they are going to become accidental landlords where
right.
they're just the new cohort of accidental landlords.
Right.
Some of the people with 2 or 3%, they're going to realize that their mortgages were actually assets
Yep.
and they'll get into it. Some of them will like it. Some of them realize they got in over their heads,
Yep.
but we will see some of that. But that going back to that point of why the type of supply matters is the last cycle, that cascading drop in supply in home prices was because there was a lot of people who were foreclosing or short selling or walking away. And that was just supply, right? They did not re-enter the market to buy. They
Right.
were going to rent. They were going to live with relatives, roommates. Like it was just very different dynamics.
Yeah, very different dynamic. And Lance has highlighted a comment here from the FHFA report that says, absent a dramatic decrease in mortgage rates, it looks like the lock-in effect could be with us for a long time. And I completely agree. Before we get to the commission lawsuit and the changes in the real estate industry, the one thing I would like you to address is rents, because
Mhm.
we also have a strange dynamic in the rental market. And of course, our listeners are investors. They'd love to see rents go up, but rents have kind of stagnated. And I'd say that there's maybe, I don't know the number, but it's just anecdotal, but 15%, 20% of the renter pool that could kind of go either way. Most of them, of course, they'd rather have a single family home, but if the deal's good enough, they'll take an apartment. And the apartment market is so oversupplied now, and it is weighing on the would-be rent increases that we might otherwise see because the overlap of the single family to apartment market, and the apartment market's going to take, the multifamily housing market's going to take a couple years to recover. So I think we are unfortunately seeing some of the results of the multifamily housing market affecting the single family market to a small degree, but it's there. Your
Yeah,
thoughts?
exactly. So the weakness in the market, especially in residential, is the multifamily stuff,
Yeah.
where there was a lot of projects that were under the works that were out there, and there was a lot more that were financed when rates were ultra low. And as those move through the pipeline and that goes out there, it's creating and will probably create more weakness. Now, the thing that matters for single family is that a lot of that multifamily that's under construction is in certain areas and in certain markets, right? A lot of the boom towns like Phoenix and Nashville and Austin are seeing the most, and they've seen more of the weakness in terms of multifamily rents. This is Zillow data, and this is whole year, year over year. So peak to trough, some of these can actually be a little like Austin is down 3.5 year over year.
Yeah, that's 3.5% in rents,
Yeah,
right?
for just multi.
Yeah.
Now, peak to trough, they're actually down 7 because from the top reading of
Right.
2022, but I don't want to get into that too much. But so multi has seen more weakness than single, and single has seen a deceleration and has seen more weakness in the boom towns where there is a lot of that multifamily supply, but single family is holding up much better than multi.
Yeah,
Uh,
I agree. I do think the multifamily is starting to affect it a little bit, though.
Yeah, and so I think where it matters the most for single family is if your property that you're investing in is in an area where your type of renter is in direct competition with that type of single family home, that's when it matters, right? Because if the rents are falling on the multi side, they're offering a lot of incentives and stuff like that, and that's enticing your type of renter, that's where it probably has more of an impact on
Mhm.
you.
Yeah. So let me just read off a couple of the numbers here because we are still up and making nice gains on rents. They're just not as great as they used to be. So 2021, I'm just looking at overall US single family home rents up a whopping 13%. That's incredible. And 2022, 8.5%. And then 2023, moderating, but still very good at 4.6%. So,
All things considered,
yeah,
especially.
yeah,
Yeah.
very, very,
Everything.
very solid rent increases. I mean, for 20 years, I've been telling people the goal is to raise rents 4% annually. So we're ahead of that still. But again, everybody in their mind does the compared to what. and they get spoiled, right? It's not as good as it used to be. That's just the reality of it. But Lance, talk to us a little bit about where this rental data comes from, because I have never found single family rental data to be that great. On apartments, they survey these, John Burns and all the rest of them, right? They survey big apartment owners and it's pretty easy to get the data. Single family is much harder.
Actually, the way that I like to track single family, and I do this Zillow data, which I like the Zillow data, but I also like to just read through the earnings reports of the institutional players, Invitation Homes, American Homes for Rent. Yeah, they of course play different than the mom and pop landlord
Yep.
types. But how I track rents is I look at the multifamily data from Zillow, I look at the single family data from Zillow, and then I like to look through the earnings reports of like Invitation Homes and American Homes for Rent. Because one thing about Invitation and American Homes for Rent is that they buy the same type of homes, and then the homes in the portfolio are the same. So
Mhm.
what I don't like as much are some of the listing sites, and I don't want to name names that put out rent reports, but some of theirs get skewed by mix shift, right? Like if what's on the market for rent is
Yeah.
changes, then that's going to throw those numbers all over the place. So I've found that the Zillow numbers tend to be a little like they're less volatile.
Mhm.
And then I like those Invitation and American Homes for Rent because I know it's the same group of homes.
Yeah, and we didn't used to have that because they weren't really that significant in terms of, institutional players in the market. And they weren't years ago, they weren't public, they didn't publish data like they do now and all that kind of stuff. So that really is handy to have. And they are much better at raising rents than mom and pop landlords are. So their presence in the single family home market pushes rent comps up. So I think investors ought to just be happy the institutional players are here. And a lot of people complain about them and say they're crappy landlords too. So you can provide a better experience as a mom and pop investor. So that's going to be good for you.
Now, I don't know if we want to get into the institutional side too much, but I have a lot of data there as
Yeah,
well.
yeah, a little
And
bit. Just touch on it for us.
what we've essentially seen there is that during the pandemic housing boom, during that frenzy and liquidity was sloshing around everywhere, there was a good amount of an uplift in the institutional buying, but really things have gotten a lot more constrained since then. This is Tricon, which last quarter Blackstone just bought. This is Invitation Homes. Same thing, went up a lot during the pandemic frenzy and then came down. You see this real big spike up there in 2023. That is because of the multifamily and office stress for Starwood, that Starwood offloaded 1,900 homes to Invitation Homes.
Because of the stress they had with their office properties.
Yes,
Right.
exactly.
So,
Yeah,
that
I'm reading that. That's my view based on all the
right.
earnings reports that I've read.
And
But
and that's a very reasonable view, and I'm glad you mentioned that because sometimes a seller, even a mom and pop seller, becomes distressed not because of the good properties they have in their portfolio. Those are performing great, but they have some other stressor in their life or their portfolio that causes them to need to sell the good asset, right? And so that's a very good point.
yeah, and that goes to the economy at large right now too, where homeowners themselves are in a fairly good spot. So the stress that's getting added and the homeowners who could get in trouble, it's probably on their credit card side or other stuff like that, whereas it's not like directly the mortgage debt. This
Right. Yeah, I agree. I agree. And they have an awful lot of equity. Anything else on the institutional before we just talk about the industry to wrap it up?
I think one more thing to show, because it's really hard to find this, and this is actually something I only give to my premium audience, but I'll share it here. I went around.
I talked about this on my show. Yeah, it's a great chart. Yeah.
Yeah, so I went around to everybody, and I went to Fannie Mae, went to Freddie Mac, Morgan Stanley, Goldman Sachs. Not everybody answered, but I got 11 research firms to give me their estimate whether the
Mhm.
U.S. housing market is underbuilt or overbuilt. And of all of these, it comes out to an average of like 2.8 million underbuilt.
Underbuilt.
Underbuilt, yeah. So Zonda's the lowest at a million estimate underbuilt.
That's the
Fannie Mae
shortage. Yep.
is 4.4 million for underbuilt. And then the interesting one is like realtor.com, where they think that the US housing market is underbuilt by 2.3 million units. but they think that single family is underbuilt by like 5 million and that multi is overbuilt, which is kind of interesting.
Yeah.
But generally speaking, if you look through a lot of the numbers in these reports, most of them think that most of the underbuilding is on the single family side.
That's interesting. So all of these 11 major firms, Fannie Mae, Zillow, et cetera, Realtor.com, Zonda, which is a real estate research market software and so forth, JP Morgan, Morgan Stanley, National Association of Realtors, Freddie Mac, Bank of America, Zillow, they all think the US housing market has a shortage. It is underbuilt by between 1 million and 4.4 million homes. Zonda is the outlier, really. Their estimate's very low. So this bodes well for investors who are in the market and are buying now because.
And one thing that I did here with this analysis
Mhm.
is I only included their conservative estimates. So,
Mhm.
like Morgan Stanley, you see there, they think the US housing market is underbuilt by 2 million homes. That's their conservative estimate. Their
Mhm.
aggressive model thinks that we're underbuilt by up to 6 million.
Wow.
Yeah.
I wish you would do a chart on the aggressive model, maybe comparison with two different colors. That would be a good one for you. Lance, do you want to talk about the industry? I mean, with this big change in the NAR settlement and, these real estate firms and the class action lawsuits over commissions and so forth a little bit, and, what changes that might mean?
Yeah, before we get into it though, I just want to make a point, which is US housing market, his affordability has gotten strained. And so a lot of would-be home buyers can't afford to buy. And a lot of homeowners who would like to sell and go buy something else, they can't afford it either. And so resale transactions are fairly low in the market right now. And I think what that creates is a good amount of angst where politicians are probably feeling the pressure. And the thing about housing is that housing affordability is not easy to fix, right?
Mhm.
It's a hard problem to fix. But what is very easy is scapegoating. And that's one thing politicians love to do. And so I think what we're going to see a lot of over the next 6 months is probably some scapegoating at the housing sector at different stakeholders,
Mhm.
whether it's Airbnb host, whether it's single family landlords, homeowners themselves, real estate
Institutional.
agents, institutional, exactly. So we're going to see a lot of that. Now, what's happening on the real estate agent side with DOJ going after the National Association of Realtors and all these lawsuits? This is kind of like a multi-decade thing where there's been a feeling among some economists and different actors within the, real estate that the commissions in the United States are too high. And so I think that's what this is. And it's just kind of come to a critical tension point. So with the proposed NAR settlement, I think one thing we've already seen is a ton of misinformation by the
Mhm.
media because the reason is they don't understand, right? And some of that is because they haven't paid enough attention. And the other part is nobody really knows quite how this is all going to shake out, right? It could be a multi-decade thing. And, JP Morgan put out an estimate this week. They think that commissions over several years will fall 30%. It'll increase existing home sales and turnover by 7%
Why will it increase turnover? That's interesting.
because sellers and homeowners would have lower switching cost.
Oh, okay. Yeah, the transaction costs are pretty high. So
Yeah.
that would make the market possibly more liquid, kind of like discount brokers in the stock market, where basically you can now trade for free pretty much, probably brought more people into the market, right?
Exactly. So that's the thinking there. Now, that doesn't mean that, so, if that even occurs, that still would not make up for all of the switching costs that have gone the opposite direction because of the lock-in effect. Because switching costs are actually, historically high right now because of the lock-in effect.
Yep.
People giving up 2, 3% mortgage rates and what that new mortgage would cost at 7%. But yeah, the thinking is if commissions go down, sellers would benefit from lower switching cost. But in terms of how it's all going to play out, it'll be interesting. One thing that we've heard from some of the politicians and some of the media is that buyers are big winners. I'd like to know how you think about it, but I don't
Yeah.
really see it that way.
I don't think so. I
Yeah,
think I think who is the big winner in this case? The lawyers. As always,
yeah.
the lawyers are going to win everything. But what's going to happen is the multiple listing service is going to just become a mess. I mean, this
Yeah.
is a mess. It's going to be so much harder to do business now in the real estate world.
Because you're
Okay.
talking about like the hoarding of the listings.
Yes, because now what we're going to see is we're going to see the data, and it's going to make your job harder because the data is now going to get a lot more siloed, and
Yeah.
all of these big real estate companies are going to have their own MLSs because you can fix prices in your own company. You just can't talk to your competitors about fixing prices. That's antitrust. That's illegal. And so, what they're going to do is there's going to be, I think, a lot more consolidation in real estate. I think a lot of these smaller brokerages are going to get bought up by bigger brokerages, bigger fish, and the bigger fish are going to have their own MLS systems. So, now as a buyer, you're not going to be able to see everything with one agent anymore. You're going to have to go to Keller Williams to see their stuff. You're going to have to go to Remax to see their stuff. Yes, there will be some cooperation, but there's going to be now a whole lot of friction in that cooperation. And the lenders are going to have to adjust the way they do financing to pay a buyer's agent commission.
Yeah.
So it's going to be a mess. And the net result, I think, and nobody knows yet because none of this goes into effect for a few more months. And even then, we won't know because it's going to take a long time to play out. But it's going to be a lot harder to buy a house. That I can say without a doubt. That's just going to make a lot more friction for buyers and buyers' agents. And so, I mean, look, it's hard enough to buy a house now. I mean, yes, affordability is a problem, but I'm not even addressing that. I'm just saying shopping for a house is hard work. Like that is a lot of work to go shop for a house. It's such a big investment. And if I'm talking about a regular home owner occupant, I'm not talking about an investor. That's easier because it's not emotional. But it's already hard enough to shop for a house, and it just got a lot harder. And so a lot of people are just not going to bother and they're just going to stay renting. And I think that's going to put upward pressure on rents. That's my view.
Yeah, it'll be interesting to see how it plays out. And it's a tough one because there's a lot of uncertainty. There's still a lot of these legal cases. We don't even know where the DOJ stands on all this,
Yep.
right? Because the thing about that NAR settlement, it's a proposed settlement.
Yeah, right.
And you would think that it would need a regulatory sign off.
Yeah. Yeah. Certainly the court has to sign off on it and they got to make sure that the class is getting its share. And of course, the law firms are getting their share. Don't you love it, Lance, when you get these notices of, oh, you're in a class action and they're suing, Verizon and the law firm made $40 million and you get a free phone charger if you ever bother to redeem it,
Yeah.
or here's 50 cents. It's like so ridiculous, but that's the world we live in. So yeah, it's going to be just fascinating to see this play out. And I don't know what's going to happen. I could be totally wrong, but I think for sure it's going to be a lot harder to buy a house. It's just going to become a much bigger hassle if the agents can't like publish the commissions that they're paying to the cooperating agent anymore.
Yeah, that makes sense.
Yeah.
And anything else you want to jump into?
No, Lance, your work is so great. I just want to commend you on all of the great work you do and all of the great stuff you put out. Glad to have you on the show. Thank you for sharing all of this. Go ahead and give out your website.
Yeah, Jason, thank you for having me on. Big fan of your work as well. If people want to read my newsletter, they could go to resiclubanalytics.com or just type in Resi Club into Google and you'll find it. There, you just drop in your email and you'll get the weekly newsletter. Each week, I'm, writing about 5 articles for free. Some of them look at new construction, new home price data, just different things going out and on throughout the residential real estate sector, or maybe some of the markets or counties with the highest rent yields. And then I also have a premium product called Resi Club Pro. It's 3 additional articles a week, very heavy research and data, metropolitan stuff, county, zip code level, and then also my inventory tracker and price tracker as well. If you want to find me on Twitter, they can find me at News Lambert.
Good stuff. Lance Lambert, thank you so much for joining us.
Thanks, Jason.